Business owners use inventory system to track and update inventory. This lesson defines the periodic inventory system, outline its advantages and disadvantages, and help you to understand with an example. For any business that carry inventory or product stored for future sales, it is necessary to keep track of what is currently on hand. Some businesses keep track of inventory using a periodic inventory system. A periodic inventory system is an inventory system that updates inventory at the end of a specific period of time. This may mean that they update their inventory record at the end of each month, each quarter, or year. Whenever the period ends, it generally coincides with the end of the reporting period, or a time frame for which a report is drawn or fall on the financial activities that occur during that time. Common reporting periods conclude on a quarterly or annual basis. Since a periodic inventory only keeps track of inventory periodically throughout the years and not as inventory when it's purchased or sold, a physical count of the inventory must be conducted. A physical count is a complete and exact count of each item in the inventory done by hand. Some businesses carry hundreds or thousands of products, so physical count can be extremely time consuming. Even for businesses that carry few products, physical count can be tedious and may take a lot of time to complete if problems happen, such as missing of parts or wrong count arise. Inventory purchases made between physical counts are recorded in a purchases account in the ledger, used to record all inventory purchases and their costs. We'll try to break it down as simple as possible in this video. The purchases accounts begin with the beginning balance of inventory, a complete record of the cost of all the items the company has acquired that will be sold. Throughout the recording period, additional inventory purchases are logged into the same ledger. This entry tracks only inventory goods, items that will be resold. Entries include the number of each item purchased, how much this item costs, and other pertinent information such as from which vendor the item is purchased and the date of purchases. At the end of the recording period, the purchases account will be balanced and the number will be generated and compared to the physical count. Adding the inventory beginnings balance, the amount of money spent on inventory items at the start of the recording period, to the total amount of money spent on additional inventory shipments throughout the same recording period will result in the cost of goods for sales. At this point, the physical count will be conducted. This physical count will tell how much inventory is in stock. Based on the record, businesses can then calculate how much the inventory is worth in the business or the ending balance. By subtracting the ending balance, the worth of the inventory on hand at the end of the reporting period. From the cost of goods for sale, the company can determine how much inventory was sold during the period and for how much money. This final number is called the cost of goods sold, or we often call it a COGS. The formula for this process is beginning balance of inventory plus cost of inventory purchases equal to cost of goods for sales. Cost of goods for sales minus cost of ending inventory equal to cost of goods sold. Let's take a look of an example to help you clear this up. Just to keep it simple, we will stick with the retail store that sell exactly one thing, the envelopes. The envelope store uses the periodic inventory system. Its reporting periods are quarterly, running from January through March, April through June, July through September, and October to December. On January 1st, the store records in the purchaser's account the beginning balance of inventory as 15,520. From January 1st to March 31st, the store orders 3 shipments of additional envelopes. Each of them costs 2,250. At the end of the quarter, the envelope store conducts a physical count of all the inventory on hand. They find, after counting the envelopes and totaling their cost, that the ending inventory for the quarter is 8,450 worth of envelopes. The question is, how much was the envelope store cost of goods sold for the first quarter of the year? Well, let's use our formula here. The beginning balance of inventory plus the cost of inventory purchases will give us the cost of goods for sale. So it should be 15,520 plus 3 shipments multiplied by 2,250, and you will get 15,520 plus 6,750 equal to 22,270. Okay, the cost of goods for sales was 22,270. This cost of goods for sales minus the cost of the ending inventory will give us the COGS. 22,270 minus 8,450 equal to 13,820. So, the cost of goods sold during the first quarter was 13,820. It should be noted that the periodic inventory system was much more widely used before computer make inventory management in real time very easy. However, some businesses still do use a periodic system for a few different reasons. Cost effectiveness. For instance, this is one reason to use the periodic system. Computer-based perpetual inventory system can be very expensive. In contrast, little to no cash is needed to implement the periodic inventory system. In fact, very small companies may be able to track inventory using only pen and paper accounting books. A periodic inventory system is also useful for businesses that sell large quantity of inexpensive products, startups, or businesses that do not need to keep track of inventory in a real time. Though there are few advantages to the system, there are also some drawbacks. One of the most notable facts that when the system is used alone, no records are kept to account for loss and other issues. Often, the periodic inventory system is used in conjunction with another inventory system to assist business owners in accounting for loss, theft, breakage, scanning errors, or inventory movement that is not tracked. So, what is the lesson summary for today? A periodic inventory system is an inventory system that updates inventory at the end of the specific period of time. This may mean that they update their inventory record at the end of each month, quarter, or year. Whenever the period ends, it generally coincides with the end of the reporting period, or a time frame for which a report is drawn on all financial activities that occur during that time frame. Inventory is only updated when a physical count or a complete and exact count of each item in inventory done by hand is conducted. Throughout the reporting period, inventory shipments are tracked in the purchaser's accounts book. At the end of the period, the physical count is done and calculations are made It determines the COGS, or the cost of goods sold during the period. The formula used to figure out the COGS is beginning balance of inventory plus cost of inventory purchases equal to cost of goods for sales. Cost of goods for sales minus cost of ending inventory equal to cost of goods sold. The periodic inventory system is more likely to be used by businesses that sell large quantity of inexpensive items, do not need to keep a daily total of inventory, and they have a small budget for accounting practices, small businesses or startups. It is often used in conjunction with other inventory systems to make adjustments to inventory total due to breakage, theft, scanning error, or inventory movement that is not tracked. Take this assessment in the below link to see if you can achieve the understanding of periodic inventory system and its definitions. As always, if you learn something new in my video, please give me a thumbs up and don't forget to subscribe to my channel and turn on the notifications bell. My name is Vivian. I am the business software coach, and I see you in my next video.